Steven Beck, welcome to Trade Finance Talks.
Thank you very much, Deepesh. How are you?
Very good, very good. And here we are in sunny Dubai, quite the contrast to London.
Yes.
At the ICC UAE Trade Facilitation Summit. You don't need much of an introduction, but still for some of our listeners, can you explain who you are, where you're from, and what you do?
I'm Canadian. My name is Steven Beck. I head the Trade and Supply Chain Finance program at the Asian Development Bank.
Thank you very much. And multilateral support is something we'll talk about later on, given the current state of global affairs. Let's take a bit of a helicopter view. We've seen the disastrous impacts of the pandemic, heightened by the Russia-Ukraine war. Which includes huge inflation rates, which makes SME and trade finance difficult. Can you just talk through the current state of affairs for global trade and trade finance from your perspective, Steven?
Yeah, definitely there are a lot of challenges post-pandemic. We've seen inflation take its toll on trade finance. And by that I mean, Deepesh, that if a financial institution has a particular limit on a country and a counterparty that it can use to support trade, the real amount of that trade limit has in effect been reduced as a result of inflation, right? Because if, for example, you were supporting a transaction that used to, for wheat or whatever it is, that used to be $100, and now due to inflation it's $130 or whatever it is, then the effect ultimately is to reduce those limits that are available to support trade, which as a result enhances that sort of trade finance gap. And those gaps impede our ability to maximize the sort of development impact, the growth, the job creation, and so on, that comes from trade if you don't have enough financing to support it. So inflation certainly has taken its toll on these gaps. Also, we've had interest rate rises, of course, to try to reduce the impact of inflation. But that in turn has resulted in countries finding it more difficult to maintain their servicing their debt. And so that's reduced the amount of hard currency that countries have available to import critical items like food or medicine and fuel and so on. So interest rates as well as inflation having a real impact. Then also the increased interest rates have resulted in the devaluation of a lot of local currencies. So that also has exacerbated the ability of countries to service their debts and import critical goods. So you've got this sort of all these sort of different elements at play, but you don't have financial institutions in this current environment, which is perceived to be more risky than it was pre-pandemic. You don't have financial institutions increasing the amount of limits that they make available for trade, and so it really is a very challenging time, and more important than ever, arguably, for institutions like the Asian Development Bank, multilateral development banks, to step in, work with the private sector to try to close these gaps, generate growth and jobs and so on.
So, and I remember we once had a conversation a couple of years ago, and you talked about the counter-cyclical nature of trade finance, i.e. during the difficult economic times, trade finance often kicks into action and fares fairly well versus economic growth. Is that true in terms of what we're seeing in the market right now? And I guess, how can governments and multilateral development banks help the private sector mobilize more capital to try and close some of those gaps?
Yeah, well, the trade finance programs at the multilaterals are very good crisis response vehicles. And so the different factors at play that I was mentioning earlier have really come to the fore in some countries like Sri Lanka. Pakistan is now also seeing some strain, and I wouldn't be surprised if there'll be some others in the future. So it's very important for us to step up and support trade, especially in countries where it's most challenging. And we do continue to support transactions in countries like Sri Lanka and Pakistan. And I'm happy to say that we've been able to keep insurance companies, private sector capital mobilized, at least in the transactions that we're involved in, because, and this relates to the other part of your question, Deepesh, around the sort of counter-cyclical and how these trade portfolios function and perform in times of stress. The reason that we're able to maintain that private mobilized sort of capital to support trade in some of these places is because we've actually never had a loss, ever, even in some of these difficult situations in our portfolio. And I know the same is true for IFC and the EBRD as well. So yes, very important crisis response vehicles. And if we look at the performance, even during crisis, the performance of trade finance has been very good.
So I guess, given what we're seeing with a lot of correspondent banks, particularly in emerging and poorer economies, the call to action that we're hearing right now is help us more. We need more liquidity. Obviously, from your perspective, you are mobilizing more capital, providing more coverage in some of those struggling markets. Why are they still struggling? What else is happening?
Well, I guess it's really a function of the gap being so large, the demand really outpacing what capital is available to support trade, especially of critical imports. But not only, also imports for export production and so on that will generate more hard currency to alleviate some of these strains. There just isn't enough capital. Multilateral development banks can't do it on their own. Mm-hmm. We mobilize as much as we can from the private sector. It's still not enough.
Yeah, and I know you've talked a lot recently about programs that promote sustainable trade finance and also alternative programs like deep tier supply chain financing as alternative ways to allow more capital to reach SMEs that need it. Can you talk a bit about some of those programs and how they can help and how ADB can support those programs?
So we're particularly enthused around the idea of scaling supply chain finance a lot more. It's an innovative sort of form of finance that looks at, assesses small and medium-sized businesses differently, and so can be instrumental in closing some of these gaps, especially for those that are even more underserved, SMEs, small and medium-sized businesses, including those that are operating in some challenging markets. The thing with supply chain finance, as we know it now, is that typically it's the first tier supplier that gets the support, and the second, third, and so on down the chain typically finds itself, still underserved. So what we're looking at now is something called deep tier supply chain finance that would sort of go through the entire supply chain to support even those sort of smaller companies towards the end of the chain. But there are some challenges associated with that. We put out a paper last year talking about the opportunities around deep tier supply chain finance, but there are challenges with respect to sort of legal questions and also some IT-oriented stuff. So we've partnered with the Bankers Association for Finance and Trade. We've got a nice group together that's working now on solving those two, the legal and the IT, the tech issues associated with scaling deep-tier supply chain finance. And in September, we hope to release, we will release our answers to those two impediments to scaling deep tier. So yeah, it's a challenge. We think that we've got at least maybe part of an answer,
Yep.
and excited about pursuing that.
Can you give any examples on I guess, how the Asian Development Bank can support correspondent banks' own supply chain finance programs right now, so some of the current programs that you have, and perhaps how they might be able to be extended to then provide that deep tier financing support?
Yeah. So we have sort of a two-pronged strategy in our supply chain business. The first has us sharing risk with some of the larger banks like Standard Chartered Bank, HSBC, in supply chain programs. So that's well underway. We're doing a reasonable amount of business under that sort of pillar. And then the second pillar has us working with local banks in our developing member countries to build their capacity to offer supply chain finance. In fact, most people in most developing countries don't really know about supply chain finance and how to offer it to small and medium-sized businesses, or any businesses, frankly. So we are providing very intensive training and capacity building with banks that we know reasonably well, very well, through our trade business. And when I talk about training, I don't mean just like a half-day session or something. I'm talking about working very closely with these guys to develop their operations manuals, working with the risk management guys, senior management on where to place a supply chain finance business within the context of their, the overall financial institution, from soup to nuts. And that takes place over 3 quarters. And then once they launch their supply chain business, we look at how it's performing, and then hope to sign supply chain finance agreements with these local banks in these emerging markets, not just the big global players like the ones I mentioned earlier. So we signed our first agreement with a bank in Georgia, and we have, I think it's something like 9 banks now going through that intensive training in a whole variety of different countries, Bangladesh, Vietnam, and a variety of different markets.
Thank you very much. That's really interesting. I'm actually going to pick up on one of your points earlier around the availability of foreign currency, because obviously a lot of trade and trade finance is US dollar denominated.
Yeah, over 90% I think of global trade is still,
But the settlement in local currency is the challenge. Can you talk a little bit more around the problem, but also what potential solutions there are, whether it's central bank support, whether it's other FX related products in those markets?
Yeah, I think depending on the market, dealing with local currency and hard currency payments is a big challenge, especially in today's environment where we're talking about local currencies being devalued. So it's a huge challenge, especially when, as we've just said, the vast majority of trade is conducted in not just hard currency, but specifically US dollars. I think that if we could have more trade settled in a variety of currencies, have more diversification in the global trading system, I think that would help. And there are some moves in that direction, but it's very difficult because the current system is deeply entrenched, right, systemically. As you know, we were talking about Chicago a little bit earlier on, major commodities exchange. Just a lot of commodities in the world are priced in dollars, right? So it's a major challenge. And something that we're constantly facing.
Thank you, Stephen. We haven't really mentioned it. It's actually more around capital and the access to money for financing trade, because as banks inevitably, and we're seeing they're retrenching from a lot of markets, they're reducing their risk and exposure. As you mentioned just now, banks such as Asian Development Bank, there's a finite amount of amount that you can do to help. Is there a case for trying to bring more capital markets, pension funds, money into trade finance, especially as we hopefully develop trade finance as an investable asset class to capital markets?
Yeah, we've been talking about that for a long time now, and hopefully that will come to pass. We created with the International Chamber of Commerce this trade finance register. I think you probably know what that is, and essentially what it is, it's statistics around default and losses in trade finance. And the hope was, and still is, that if we can refine that data to a point that we can demonstrate to potential investors that this is an asset class that they should be looking at, investing in, then that would be a new source of funds to help close some of these gaps. There have been some minor moves in that direction, but not nearly enough. And so it continues to be something that we need to work on with the investor community to explain this asset class and attract more capital into it.
Thank you very much, Stephen. So we've covered a lot of ground, and I guess one final question. We're living in a very polarized world right now, and there's continuous need to recognize, you and I know, the value of global trade to bring economies out of poverty and help economies prosper on a multilateral basis. What are your take homes, and what's your message to the international trade finance and practitioner community?
Well, I'm glad you asked that question, Deepesh. Trade is responsible for lifting millions of people out of poverty. It's really critical to development. So it should be of real concern that in today's sort of political and economic environment, there is a lot of talk about deglobalization and trade being the major component part of globalization. I think that needs, that needs to be addressed. I don't think there are enough of us talking about the importance of trade to the world, to development, and its benefits. That being said, trade does have its weaknesses. There are losers in trade. There isn't sufficient inclusion in trade. It's been estimated that up to 80% of the global carbon footprint can be traced back to global trade and supply chains. So, my main message, Deepesh, and this is something that we're trying to do now, is to not sort of throw the baby out with the bathwater. Don't want to get rid of globalization and trade being the major component of it, but let's look at its weaknesses and work to fix those. So, during the pandemic, we saw just how fragile global supply chains can be and just how important they are. I mentioned the environmental component, inclusion. What we need to do is we need to make global trade and supply chains more resilient. That means more digitalization. We're doing a lot in digitalization of global trade and supply chains. That's critical to making them more resilient. It's also critical to making them more transparent. The metadata that we can get out of digitalizing the process of trade could be extremely powerful in closing some of these gaps, especially for small and medium-sized businesses, and for lowering barriers to entry into global trade. So that would address at least some aspects of inclusion. So I think it's really important for us to tackle some of these issues and to look at how we green trade and supply chains. As you may know, that we're involved in a number of different initiatives to track and report carbon throughout the supply chain. So we're living in a very exciting time in the history of trade and supply chains. And we've got a great opportunity. The time is ripe to address these issues, and that's what we need to do. And we need to, at the same time, talk about how important and beneficial trade is to avoid, more of this talk of wanting to sort of deglobalize, and which I think would be quite detrimental.
Yeah, thank you very much, and what a good way to round up our interview. Resiliency, transparency, and data are probably some of the key pieces we need to work on to really address those global gaps that we discussed, and also financial inclusion, which are so important to each and every one of us to address within the community. Stephen, it's been an absolute pleasure having you here in Dubai.
Thank you very much.
Take care.
Thanks, Deepesh.